Welcome to this week's episode of What's at Stake. I'm your host, Ylan, Managing Director at Penta. Our loyal listeners are in for a special treat today as we're reuniting with our friends from Markets Policy Partners, John Fagan and Brendan Walsh. John and Brendan, great to have you back.
It's great to be back.
Amazing. Hope you guys have been having a great summer. And as always, all econ nerds look toward the Fed conference in Jackson Hole at the end of the summer as a way to cap off the season. Today, we'll be talking about the Fed, the economy, and a possible rate cut as that Jackson Hole Economic Symposium gets underway. This, of course, is the annual central bank conference organized by the Kansas City Fed that brings together central bankers, policymakers, academics, and economists from around the world to discuss monetary policy in the shadow of the beautiful Grand Tetons. So the last time we got together, guys, I think we were still discussing higher for longer and the possibility of no landing at all for the economy and for the Fed, which kept trying to cut interest rates, and it seemed like they never were able to get to it. Now it seems like the deal almost feels done.
Yeah, it does. And, from our perspective, we're a little biased because we thought the deal should have been done at the July meeting. So our call for the first rate cut of this cycle was the July meeting. And we established that call like in the fourth quarter of last year. So we really held it. We were wildly more hawkish than consensus, and then consensus swung until we were more dovish than consensus. And I think, looking back at the not just price action, but what's happened in the data since then, there's a sense that the Fed probably missed an opportunity to calibrate its message a little bit, if not cut rates outright, at least calibrate its message on a little bit of a more dovish side. And there's a sense that they've got to course correct, and they have been doing that rhetorically. And the markets have been debating whether they should, start off with a 50 basis point or whether they could start off with a 50 basis point cut. And that's kind of where the debate lies right now, just how dovish the Fed is going to be.
Yeah, I think to your point, John, it's interesting that you guys were calling for that first rate cut in July because, if the Fed does end up going for that unexpectedly large 50 basis point cut, you'll basically be right in consensus, right? They would have been where you predicted they would be, at the end of the fourth quarter. Brendan, what do you say? Do you think they're going to go for the supersized cut?
I think they should, but that's why we thought it made a lot of sense to do it in July. Both the economy kind of needs it. Secondly, the presidential election is going to be very much ramping up in September. And now if you cut 50 basis points, you make yourself part of the political narrative, which is exactly what they don't want to do. So they missed a golden opportunity. And I think the data warranted it. And because they actually weren't wrong about inflation being transitory. Inflation was transitory, both here and globally. It just went up way higher than everyone thought, and it lasted, probably 6 months longer than they all thought. But now there's so many. The members are so focused on, proving that they have the merits to, fight inflation that they're ignoring their dual mandate. And I think recently, Chicago Fed President Austin Goolsbee has been trying to send that message out that, look, guys, we've got two mandates, and the labor side of the economy is starting to show cracks.
Yeah, there was a lot of concern about the July jobs report showing a growth in jobs of about 114,000, less than expected. But, for so long we had seen the job number come in higher than expected. And folks kept saying, when are we going to slow down? So it kind of almost feels like when the slowdown happened, folks were surprised and then started to get a little bit worried. So, I feel like there used to be an era of, bad news is good news. And now it's sort of like the news you wanted ends up being not what you wanted after all. So maybe watch what you wish for.
And also on the labor front, the labor data is prone to huge revisions, and we're actually getting that annual revision this week. So, there's a chance that, I think it comes out tomorrow, that we might have created 1 million less jobs than the official data said. which very much changes the picture. And they don't know what it is today. The BLS will tell us what it is tomorrow, but it could paint a very, very different story.
Yeah, and this was the data came at a time when market participants were getting a little bit more concerned about the consumer. The U.S. consumer has obviously been just, on a spending spree post COVID, shifting from sort of goods during COVID, as we've discussed, to a services spree, that revenge travel, and all of the different kinds of spending opportunities that were denied them in the COVID years. Really, plus the dry powder that they had, the savings and so forth, and the windfalls from COVID relief packages and so forth. There was always going to be a time when the consumer just tired out, right? And this was coming. The data on the labor market hit when we'd gotten a series of commentaries from corporations coming out with their second quarter earnings, talking about a more tired consumer, a more discerning consumer, trading down to lower price points, and the McDonald's bringing back the $5 meal deal, right? Yeah. I mean, stuff like that.
And everyone involved, the travel from the airlines to the hotels to the Airbnbs, had to cut their forward-looking guidance because the consumer just it was okay last quarter, but they're seeing a huge slowdown here in the third quarter.
Now, retail sales, the latest data, didn't tell that story, consistently, right? We've seen some noise in the data, but the expectation is that there is going to be sort of a negative feedback loop between, a weakening job market where people are a little bit more concerned about their job prospects and pay prospects, and so they tend to, cut back a little bit more, which worsens the economy, which feeds into a weaker labor market and so forth. So this is the kind of cycle that the Fed finds itself, staring down right now, and maybe wondering whether they're, maybe a little bit behind the curve. But there was a sense that the sort of panicky market reaction that we saw in this idea of, an impending recession and a big Fed mistake, there was also, at the same time, there were a lot of other factors going into it, right? Earnings season was coming out with some less than inspiring AI related results, and tech ended up kind of leading the downside. And the markets were, you could say that the equity market was pretty overdue for a correction in any case. And so there were a lot of factors sort of conflated. It wasn't just, all of a sudden the market's lurching into this panic mode about a potential recession.
Yeah. So are you talking about, John, the big drop that we saw in the S&P? Well, how long ago was it now? Time is a flat circle, but maybe it's almost a month ago now. But when it dropped,
a month ago,
yeah, it dropped about 3%, the biggest drop in about 2 years. And I actually thought about you because everyone's blaming it on the Japanese carry trade, right? And I'm thinking about, well, maybe I missed my window to travel to Tokyo.
Yeah, that's right. Actually, I happened to be in Tokyo at a time when the yen was spiking. I should have been able to predict that. So, the BOJ, it was one of those things that, in isolation, it wouldn't have been that big a deal, but it happened sort of, in train with all of these other events that kind of kicked the markets when they were already down a little bit, and fueled some, pretty eye-popping price action. I happened to be in Tokyo that day, and there was there was a lot of chin scratching about what on earth is really going on in the Nikkei. But again, when I was at the Treasury Department and running the financial markets analysis unit, the prime distinction that you really had to work to achieve was between, price action that, even if it seems a little disorderly, what is driving it? Is it a systemic, is it a systemic level risk that is going to, that is going to keep that trend, of high volatility and downside in risk assets, going through, to some pretty dark places? Or is this, as extreme as it might be, is this, price action that is, based on sort of corrective activity, a confluence of factors, none of which necessarily rise to the level of some kind of, big systemic shock,
And a lot of it is just simply positioning.
Yeah, positioning issues.
The market got too one-sided on whatever the thing was.
Yeah, it got way offside, and so that was kind of our take on it. And since then things have calmed down to a considerable degree, and there's a sense that the Fed isn't going to be cutting 50 basis points necessarily. Flashback week and a half ago, the odds that the Fed was going to be going big guns 50 basis points to kick off was over 50%. People were talking about an intermediate cut. I mean, we thought that was a little overheated.
But it also is indicative of, while the Fed has a mandate from Congress for full employment in the United States and price stability in the United States, they still are the global central bank of the world. Everything that they do sends ripples through other major economies, and it can send tsunamis through small ones. So it probably is kind of lucky that they're all out there together in Jackson Hole. Not necessarily that they could coordinate, but at least they can discuss, the path forward.
And certainly everyone's going to be looking toward Powell's speech on Friday for, any confirmation that a rate cut is on the way, what size it might be, and just sort of his broader outlook on the economy overall.
We're starting to see a lot of the big banks give their opinions on it. But no one's calling for a 50 basis point cut, but, that he will start saying, maybe we go meeting 25, for the rest of the meetings.
Right. Maybe not all at once, but maybe do they move more regularly than they would have otherwise? Mm-hmm. The other thing, too, which kind of struck me about the market volatility that we saw, is that it's a good reminder that, the markets are not necessarily the economy. Right. And we've had this
especially
debate.
The equity market.
Yeah.
It's the one we pay attention to, but it actually is the smallest, kind of goofiest one.
Right. Everyone says, don't look at your 401k, but it's a small part of what people actually, sort of hits home and how people actually view their finances. And your point earlier about the million jobs, the fact that we might have created a million fewer jobs than we thought, we've talked a lot about why does economic sentiment seem sometimes divorced from what the economic data is actually showing us? And maybe that's one of the reasons why, right? That people weren't feeling as optimistic about their job prospects or optimistic about their finances, because now, hey, look, we find out maybe the job market wasn't as robust as we thought after all.
Yeah, and the Fed's labor survey came out yesterday, and that it confirmed that people are still doing okay now, but it's harder to find a job. People are less confident in, leaving a job or quitting a job without a job. So it's not that everything's falling off a cliff, but we're starting to see cracks. Mm-hmm. And the problem with the labor market is it weakens, and then it kind of falls, like, precipitously. So the Fed is very much running the risk of, maybe being asleep at the wheel and focusing on backward-looking data, especially with the inflation, which basically all the inflation is in the shelter index.
Right. I wanted to ask you about that.
You go around the country, you're seeing a lot of pain, especially in the big cities. I saw data today that house prices are, no one's buying it yet, but the asking prices in certain of the hotspots in Florida are down 30%, back to the 2019 levels after the pandemic boom that happened. But that's how high rates work. It takes a while to seep through to the economy, and now we're starting to see that pain.
Yeah, there's a forecast from the Mortgage Bankers Association that predicts that by the end of the year, mortgage rates will be at about 6.6%. Currently, about 7%, I think, is the going rate for the 30-year fix.
We were above 8% for a long time.
Yeah. So I mean, that could be real money in the pockets of American families, and also certainly, increase demand for the available stock that is out there.
Exactly.
Maybe it'll also even convince some of those people who might be locked in that it's actually time to. They feel more willing to sell. They could buy something else, and it won't break the bank in the same way. Yeah, it's all about perspective, right? I mean, 6.6% might sound high compared to where we were in 2020, but if your baseline is now 8% when you've been looking, then it feels like a pretty good deal.
Yeah. but also the price of the house can adjust too. So, maybe the monthly mortgage payment can be somewhat similar if the asking price comes down from the kind of craziness we hit in the middle of the pandemic.
Yeah, that's also a good segue to talk a little bit about some of the economic policies that we've seen be floated by the presidential candidates as we get really into the thick of the election cycle. Vice President Kamala Harris has floated the idea of a $25,000 homebuyer tax credit to help stimulate the housing market. Obviously that would maybe draw more people in from the sidelines, but would make some of the bidding wars perhaps even a little bit more fierce than they are now.
Yeah.
I was talking to a friend of mine that, of course, all economics is local, right? So I was talking to a friend of mine who said that they bid on their house maybe 6 months ago, and there are 20 people that they had to fend off in order to win the bid. So there's still certainly a lot of competition out there, especially as rates start to come down.
Yeah, and obviously, there's a sense that we saw this particularly when President Biden was still the candidate, and after the debate performance was lagging pretty significantly in the polls, there was this momentary realization in financial markets that the Trump economic platform was pretty clear at the time, and there was a sense that if he wins re-election, then or wins a second term rather, then he would probably take the Senate. The Republicans would take the Senate and the House, giving him a much clearer path than a second term for Biden, which might have well come with a Republican Senate. So Trump might have, the sense was that Trump would have had a much clearer path to legislative success, being able to actually implement his economic program, and the sense that there's been a lot of discussion about sort of the inflationary elements, and so just to review those, the idea of obviously tax cuts, that was like the signature achievement of the first term, and he was going to re-up those and maybe even double down on them. At the same time, the tariff, very serious about tariffs. He did that in the past, and looking to again sort of double down on that. And Lighthizer name coming up as potential Treasury Secretary would certainly signal a very muscular kind of pro-tariff response, alongside with the immigration policies, even potential deportations, which would naturally tend to tighten the labor market, and essentially a stated weak dollar policy, and then alongside the a more concerted, more sort of official pressure or a campaign to influence Federal Reserve policy. Those are very those are, all else being equal, those are an inflationary set of policies, and there was this moment where Trump surged in the polls, and the markets were trying to sort of grapple with just how inflationary those policies might be. And now we're obviously getting a clearer sense of what Kamala Harris would feature.
Yeah, but that's been interesting on that front, because President Biden was completely and utterly blamed for the inflation that happened. But for whatever reason, once Kamala took over, it didn't kind of follow her to the same extent. So clearly, she came out with her economic policy, and you have to kind of address the inflation issue and come up with some sort of solutions, being like, that one wasn't my fault, but I'm going to fix it. I wouldn't necessarily recommend any of the things that she proposed, but the simple reality is, if you want to fix inflation, you cut spending and you do deflationary things, which that's not fun to get you elected. So
no.
That's not a campaign platform, Brendan.
Yeah, which has been criticized, but my sense is kind of they're more for the campaign necessarily than they are something that would or could even get implemented.
Yeah, the Senate math isn't that different, at least right now. It seems, from the sort of the switch to Harris as at the top of the ticket. The sense that she would probably still have, even if she prevails in the general, she's not going to have necessarily the Senate on the Democrat side. Possibly, maybe the argument would be, well, she's got a lot more momentum, and it would feed down the rest of the ticket. But there's some really tough races Democratic senators are facing. So, the right now, markets always struggle to price in political outcomes, and with the polls so tight right now and the unprecedented nature of this election cycle, with an upcoming debate between Harris and Trump, which markets are going to potentially pivot on that. So it's going to be a very hard thing for markets to price in one economic policy platform over the other, barring some like unforeseen.
No, I totally agree. Lately, the markets have been trading on data and Fed policy, and you kind of see the Trump trade or the Harris trade kind of fading. And I agree also that the debates are going to be really important, because it's kind of ironic, I guess, that you have a former president and the current vice president, but so much of the focus was on Biden, being old, and then now Kamala, she's here, but we don't actually know necessarily what her policy is. Trump doesn't really make it onto the nightly news too much. So we're almost being reintroduced to two people through these debates that we theoretically should know a lot about, Yeah,
reintroduced to it's a different dynamic at the very least, right, between the two. And that is a good point that, the first debate, I remember, being prepared to, brief my clients on the economic policy positions they take and, the substance of the debate. And obviously it was completely overshadowed by the dynamic itself and by Biden's performance. And so, we didn't get much in the way of substance. Perhaps this time we will. And, for better, for worse, Republicans had been messaging a lot of Biden's policies, by attributing them to him by name, Biden-inflation. Right now, that doesn't really help them when you have a new candidate, and you're struggling to define her, and she's struggling to define herself.
Got pinned to him, and I think that's why it's not necessarily carrying over to her.
Right. Exactly. Though, to be fair, the Committee for a Responsible Federal Budget did put out an analysis of her agenda as well, looking at some of her policies and proposals to expand the child tax credit, for example, to continue ACA premium tax credits, and of course that $25,000 homebuyer tax credit. Their estimate is that if all of those policies are made permanent over a 10-year window, they would add about $2 trillion to the federal deficit. So, there's inflationary forces at work throughout the campaign cycle for sure. But the one thing that I think would be obviously one huge difference, there's a lot of them, but one big thing would be something that you mentioned, John, which is the pressure on the Fed. I mean, we know that Trump and Powell are not besties by far, right? Trump has said that he may not even reappoint Powell, and he would only let him continue to finish out his term, which I think goes through 2026, if Powell continued to do the right thing, which one assumes is cut interest rates after Trump is elected. So,
yeah, right. Well, when we were, back in, if to take the Wayback Machine, not that far back, but to 2019. During the U.S.-China trade fight, which obviously was precipitated by Trump's White House policies, there was a sense that Chair Powell was being bullied into rate cuts to enable and allow that policy to go with less volatility, less market reaction, and all else being equal, the Fed wouldn't have cut rates with the zeal that they did in 2019, had it not been for the pressure put on by President Trump at the time. There are plenty of ways in which you see people in Washington D.C. do something that the Fed's going to be in a rate cut cycle, right? And it's hard to say but for the pressure from President Trump, would they have cut as much, right? It's just a speculation, cocktail parlor chatter game that you can play. And you can certainly see a situation in which Powell does the right thing, according to President Trump, if he's reelected, and the Democrats would grumble, well, he's, cutting more than he would otherwise. But the Fed's in a rate cut cycle. So how can you really say, right? It's obviously it would be different if, the White House took a completely new approach interactions with the Fed and took overt steps to attack Fed independence and change the whole dynamic there. Is that possible? Sure, but we certainly saw in the last term, Trump griped about Powell and put a lot of pressure on him, but there weren't a lot of times when, I think that when they were more aligned than they weren't, I think, when you look back on it.
Yep, totally agree.
Yeah, it's hard to prove the counterfactual, right? What would Powell have done in the absence of a Trump presidency? It's really hard to say. One other thing that we should talk about is Kamala Harris's as well. Her views on Jay Powell in the past. She has not been an ardent supporter of his. In fact, she voted against his nomination as chair back when she was still a senator from California. So she has also been someone who has not always supported the stances that he's taken and has maybe looked to others for her economic advice. But it seems like she would probably be a little bit more traditional, let's just say that, in terms of her interactions with the Fed and allow them the independence that they've historically had.
Yeah.
Yeah, I mean, the voters sent Trump to the presidency to essentially smash sort of existing norms, right? The voters would not be sending President Harris, with the same mission, right? It's a very different style, approach, the sort of Washington, like the consensus, operating style of Washington, D.C. And so, yeah, I mean, based on everything that we know, she's, going to be in the same kind of mold. I mean, behind the scenes, there's obviously like a robust dialogue, right, between Treasury and the Fed and the White House and the Fed, right? It doesn't play out in public the same way that it does with, Trump's policy by tweet. And so, exactly like the degree of pressure and, sort of that there can be more than meets the eye, obviously, even when you're sort of operating in the normal course of, Washington business. And so the expectation would be that, so if Kamala Harris were elected president, there is definitely speculation that Lael Brainerd would be, this would be another sort of, Fed alum, a high level Fed alum running the Treasury Department. And that doesn't necessarily mean the institutions are completely simpatico, but, definitely comes with a sort of communications, the connective tissue, very strong, I think, is one way you can put it.
Yeah, absolutely. Well, let's end on an optimistic note, which is that Goldman Sachs, after raising the odds of a recession to, I believe, 25%, has now cut it back down to just 20%. So I guess we can all sleep a little bit easier. But it does seem to suggest that after some volatility in the markets, volatility across the political landscape, that there's hope that if the current trajectory continues, that, we'll be able to move into the next cycle of the economy and the cycle of potentially Fed rate cuts that could leave us virtually unscathed.
Yeah, that no landing scenario may be coming back, but the sense of, there's the idea of, a recession being something that you have to avoid at all costs. Obviously, when you're an economic policymaker in the government, and I saw this close up, there's an acceptance that there's a business cycle, right? And recession
is so many iPhones.
Yeah, right. Exactly. Just like, market corrections can be healthy, economic corrections, as dismal as some of the impact can be, from a sort of bloodless, spreadsheet and economic standpoint. It's hard to have a business cycle if you don't have a recession and now and then. And so, the idea that the economy can slow down and whether it's a moderate recession, a mild moderate recession that the Fed cuts its way out of, and maybe there's a fiscal response depending on how the election shakes out in the White House and Congress. it's not the end of the world. And, to have been thinking back at 2008, there's a sense that, you can't have a recession without some sort of cataclysm, that shakes the world, financial markets. But that's not necessarily true. You can have a normal garden variety.
Well, I mean, I think you need that to have a severe recession.
But
since the financial crisis, not just the U.S. economy, the world economy has been very steady. We grow at 2%. So I feel like we almost have to redefine what the definition of a recession is for the general person on the ground. Like 1% growth could feel a lot worse than normal, because you've never really experienced what it is to have negative 1% growth. And I think that comes through in a lot of the surveys and things like that. Like, if everything's not perfect, we just say, oh, it's a recession, and then there's a lot in between a recession and just normal, trend growth. But if you're losing your job, that's a recession. It doesn't matter if someone else has a job.
And if you're the Trump team, obviously you want a recession, right? Yeah. You wish you had the recession starting. He's pretty upfront about it. But essentially, like, from political, whichever candidate you are, you would want a recession to hit at the beginning of your term, right? Yeah. You can blame it on the other guy,
so that you can end on the upswing in the business cycle. Is that the
absolutely? Yeah. Start on the low.
It'll be boomtown.
Yeah.
Absolutely. And so I think it's even more so for President Trump, for a Trump second term, obviously, because he's got such a stimulative bent to his economic packages. It's all gas, no brakes. And so which looks inappropriate if the economy's strong or even, kind of stable with, like, kind of dormant inflationary pressures. But if you're in a recession, then it looks a lot more appropriate. And, for President Harris, if she's elected, she wouldn't get the same kind of blame for a recession that shows up early in her term, and it could certainly give her more leverage in terms of getting some of the social programs she wants in place. If people across policymakers across the spectrum are hearing it from their constituents. So it wouldn't be the worst thing politically, but obviously you have to assess and and realize the human cost of recession is real.
We're all jaded Beltway veterans. Reminds me of the old adage: never let a good crisis go to waste. Right? Never let a good recession go to waste. I'm sure that is the motto of many a political candidate. John and Brendan, thank you so much for joining me again today. It was great to have you guys back on. To hear more from John and Brendan, we encourage you to tune into their podcast on Markets Policy Partners called The Macrocast, which breaks down the news of the week at the intersection of markets policy and economics. And to our listeners, you can remember to like and subscribe wherever you listen to your podcast, and to follow us on Twitter/X at PentaGRP and on LinkedIn at Penta Group. I'm your host, Ylan, and as always, thanks for listening to What's at Stake.